This is terrifying. I'm your host, Steve Van Metre, and thanks for joining me today. And our lead story, U.S. households face the unthinkable as the next crisis emerges. And this is something the political elites cannot see as happening. They do not understand that the average American is struggling right now, and the situation is getting worse. And we will make the case in today's show of how this could be the tipping point that sends the U.S. economy into the next recession. Plus, we have a sponsor for today's show, Dyadic International. They develop and manufacture vaccines, antibodies, and treatments, and they have a bunch of big news coming over the next 12 months, which is why two analyst firms have a strong buy on their stock. This is not one you're going to want to miss out on. You can find them on the NASDAQ under the symbol DYAI, and if you're a technical trader, you're going to love this chart setup. I'm going to show you a potential 46% move to the upside. Stay tuned to the end of the show or check out the pinned comment or description for more information. Now let's head over to Bloomberg because I want to set today's story up with how the mainstream media is actually spinning the news, and then we're going to look at the truth. And here we can see the headline is Capital One to buy Discover for $35 billion in this year's potentially biggest deal. Of course, this is subject to regulatory approvals, and this seemingly came out of nowhere. And yet, I want you to see just how the mainstream media spins this, as this is just a wonderful thing. It's going to be a great benefit for the card holders, and then we're going to look at perhaps the real catalyst behind this, because what it suggests is the fabric of the U.S. economic engine is breaking in a big way. As Capital One holders will own about 60% of the combined company, and Discover holders will remainder, according to their statement. This will generate pre-tax synergies of $2.7 billion. And so here you can see, pointing to Wall Street, look, this is a great deal. We're going to save a lot of money here, and that's going to be a big boom for our stock prices. The main rationale is the fixed cost of technology that results in bigger being better. This fact has been reshaping many industries for many years, and I see no reason to think that the trend toward fewer but larger firms will end. Of course, we know what happens when companies merge. That means Americans hit the unemployment line as a result. But let's continue to see how the media looks at this, because back in January, Discover said this fourth quarter profit dropped a whopping 62% as the company continued to grapple with the fallout from compliance and risk management lapses. And I'm going to show you that this is actually only going to get worse, and that perhaps Discover was eager and desperate to find somebody to merge with. When you see what's really going on, both of these companies are covering up what is facing to be an economic disaster, as U.S. households are now facing what is the next crisis. And the company halted buybacks last year and has been seeking a buyer for its student loan business, suggesting that, well, they're not making money there either. In fact, in December, Discover appointed Toronto Dominion Bank's Michael Rhodes as his new CEO, lining up to take over by early March. But here's the real story, my friends. With charge-off soaring, Capital One to buy Discover, creating credit card giant. And this is an issue because when you see charge-offs, what does it mean? It means people aren't paying their bills, and they haven't been paying them. And the more that happens, when you see an increase in delinquencies and charge-offs, it says the economy in the U.S. is near its breaking point, and that the American dream of being able to buy things we don't need with money we don't have and do that today, well, it's coming to an end, along with a lot of hopes for a big surge in first quarter earnings. With both delinquency and charge-off ratios at the two largest credit card companies in the U.S. surging in the past 2 years to the highest level since the COVID crash. So this is significant because in a booming economy, there's always going to be people that fall behind. That's just the nature of a debt-based system. There's always going to be people in delinquency or default. The issue happens when these numbers start to increase. And now we're at the highest level since the COVID crash, and looking like it's going to get worse as we see this is prompting speculation among traders that the U.S. consumer is set for a painful hit. We're making the case this is a consumer-led crisis starting to form. And here we see from Goldman, I think we're going to keep ignoring any consumer concerns for now, but some of these numbers from Discover are pretty glaring. Well, of course they're going to ignore the numbers because all they care about is the stock price going up. But here's the real issue. This is affecting U.S. households. And there's a reason why I said the political elites can't see this, because they're part of the reason this is happening, and it's not a good thing. And here we can see the combined Discover and Capital One net charge-off ratio is skyrocketing, coming here out of what was a very low point. It makes sense because when the economy is booming and people have money from the government, there was not an issue paying their bills. But now these numbers are rising. So you start to think about the real picture here of why did these two companies merge? Well, sometimes you've got to cover up the garbage to hope no one sees what's really going on. And it's hardly surprising, Zero Hedge notes, that the easiest way to cover up the growing delinquency rot below the surface is simply to throw billions in synergies at the problem, while also combining two very ugly balance sheets in hopes of confusing the short sellers. And sure enough, earlier today, Wall Street Journal and Bloomberg reported that Capital One plans to buy Discover in a deal that would combine the two largest, well, get this, and ugliest credit card companies in the U.S., and this is indeed the underlying issue. Its delinquency rates are rising. Now, we talk about the U.S. banking system here. What do we continue to hear from the regulators at the Federal Reserve level? They say, look, we know banks are going to fail. And what are we going to do? We're going to just merge them with another bank. And in the process, maybe we take two bad banks and we get a good bank. Well, that didn't work out well for New York Community Bank at all, as we see their stock price resuming its downward trend. And this is a case that regulators do not understand what they did. These political elites have no clue what is happening, and it's impacting American households now in a major way. Now let's talk about how this happens, because when we look at the delinquency rate on credit cards, this data is quarterly and coming out from the, of course, federal government against total compensation in the form of average hourly earnings multiplied by average weekly hours of production and non-supervisory employees. That's shown in red on a year-over-year rate of change. Now, it makes sense when you see an acceleration in wages, particularly at a point where there's high debt levels and high debt service costs. Well, then consumers can make their payments, and that's really important. But what happens when you see total compensation growth decelerate? Well, that's where you start to find that not everybody is in good financial position. And sure enough, what do we note? That during periods of deceleration, here you see the delinquency rate in blue go higher. It happens again going into the dot-com bubble. The same effect. That slowdown heading in global financial crisis led to a huge surge in delinquency rates. And now we see a massive deceleration in total compensation, led by a collapse in hours worked, leading more American households to enter delinquency. Of course, that means the next crisis here is emerging in a big way, and yet we hear nothing, again, nothing from the political elites on what they're going to do to keep this from destroying our banks yet again, as we look forward into March, what we think could be the beginning of the next banking crisis. And what this means, of course, delinquency rates are also linked very closely to continued unemployment claims, because when you think about it, people that get on unemployment, they have less income. And well, when you have a family to feed and you have bills to pay and you have a roof to put over your head and you have to deal with inflation, well, there are some things that just don't make the cut when you don't have enough money, and that generally starts with credit cards. Here you can see its continued claims going back even into the 94, 96 era, where there was just a small increase in continued claims, though the delinquency rate rose quite a bit, and you can see the relationship just got tighter and tighter. Look at this going in the dot-com bubble, continued claims skyrocketing. There goes, of course, delinquency rates here again in the global financial crisis. And now it makes perfect sense. We have nearly 2 million Americans on unemployment. Of course, we'll get an update on that number this week, suggesting the longer they are on this, the less money they have to pay their bills. This puts the banks in a serious situation. Of course, it's also the banks and the Federal Reserve that created this, because what happens when the Fed inverts the yield curve and money curves, banks tighten lending standards. And sure enough, we see the net percentage of domestic banks tightening standards for credit cards. That's shown in red, and it's on net tight when it's anytime it's over that horizontal green line. And what do we know? When banks tighten lending standards, which means they restrict the creation of credit or in the case of a credit card holder, they limit, of course, the expansion in the limit, or they limit how many new cards or how much money people can get. Well, that means when you're short of money, well, you head right into delinquency, and here you can see the beautiful relationship there. That delinquency rate likely to continue to go higher when we see, of course, the next quarter's data. And this has a big impact on the economy, because when consumers enter delinquency and they go into charge-off, of course, their credit ratings are going to get hit, but that also means their spending is going to get hit in a big way. And we see that today from Home Depot. As they note, the sales slide for the fifth quarter on weak housing demand. We see here now for the fifth straight quarter. And notably, what did we just see in the Discover and Capital One data is that delinquency rate, that charge-off rate, has been going higher for over a year now. This is a problem as the country's largest home improvement retailer felt the impacts, they say, of higher mortgage rates. Well, I think has everything to do with slowing compensation growth and tighter credit conditions. And here we see comparable sales, a key indicator of the retailer's health, fell 3.5%, while they predicted a 1% decline. And it's not going to get better for Home Depot at all, because we just look over the housing market. We got this from last week. As housing starts to collapse in January, this is now the biggest month-over-month decline since the COVID lockdowns. And here we can see after single-family homes plunged in December, analysts didn't expect much of a bounce back. Well, they were way off as they puked 14.8% in January. That is huge. And then we also see December's 4.3 month-over-month decline was revised up to an increase, but building permits also tumbled as the housing market starts to stall out. Well, that's more and more people that are not going to have as much work as they need to. That means companies like Home Depot are not going to be expecting big earnings growth, while the market is planning on that for the first quarters. We continue to see equity indices here in the U.S. push at all-time highs. It's all coming back to the fact that what the Fed did is now having a meaningful impact on the economy. But if we ask them, well, they'll say that's nothing of the sort. As the Fed's golden path to soft landing is aided by productivity boom, suggesting that all of this is actually good news and all according to plan. Well, not so quick, Fed. As productivity growth has averaged 3.9% in the three quarters, more than triple the rate seen in the decade prior to the pandemic. And when workers are more efficient, firms can generate more money to raise wages without charging higher prices, so monetary policy can be a little bit less concerned about inflation, suggesting that this is fantastic news. But what is some of the reasons that drive productivity higher? Well, I'll show you here in a second. Because productivity figures, which the BLS measures as output per hour, they do tend to be volatile, so the recent trend, while encouraging and supportive of a soft landing and the Fed achieving this victory, has led some Fed officials to be cautious. Well, of course, they're cautious. They wait until the crash actually happens before they react. Let's take a look at this productivity data. Here we show in blue in output per hour against the consumer price index in red, both on a year-over-year rate of change. It makes perfect sense because as productivity goes up, what you tend to see is a corresponding with a slight lag decline in the consumer price index, which makes a lot of sense because as the article suggested, if you have a worker that can do more per hour, well, that means they're more productive, and that brings costs overall down. What they didn't tell you, what they're not pointing out, is the sacrifice that comes with this. But let's look at what the Fed has to say here, because yes, a rising productivity means inflation comes down. We'll look at the real reason why. I got my fingers crossed that continues. This from Chicago Fed President Austin Goolsbee. He said it's shockingly good. This trend has supported wages being higher and the economy leading to a golden path of perfection led by the Fed of continued growth and low inflation. At least that's his hope. Now we're going to bust that myth here in a big way. But for the past 3 or 4 quarters, productivity has been quite strong. This from another member, Barkin, of the Federal Open Market Committee. But I don't think it's high enough for me to conclude that we've gone to some different productivity paradigm. Well, of course we haven't, and that's the point I'm going to make. But if we have a few more quarters like that, we're going to have perhaps a change in mind. And because a step up productivity could lead to a roaring 2020s, if you can believe that. This according to Ed Yardini, president and founder of his own firm. He estimates that productivity might increase 2.5% or even more annually for the rest of the decade, much faster than the Fed's estimates, suggesting that indeed boom times are here and the Fed engineered the impossible. Well, the problem is they don't understand what really tends to drive increases in productivity. One of those is the fact that there's fewer people working at the company, and those that are left start to wake up to the reality is if business gets any slower, they're the ones who are next. And the evidence of that is rather conclusive as we go back to the labor productivity data and now overlay continued claims shown in red. And sure enough, as employers have less people working, well, the output of those who are remaining on the job site, well, tends to go up. And you see these big spikes in productivity are led by an increase in continued claims. We see that effect happening exactly right now, right on schedule. But as we know, according to the Fed, this is good news. But as we look around the world, what do we see? That even other central bankers are seeing the same thing and starting to get excited, but that perhaps that maybe rate cuts are coming soon. As the ECB says the Eurozone wage growth slowed in the fourth quarter, they are championing that as great news because as we know that when consumers cannot keep up with inflation, which they haven't been, because their pay is not going up enough, well, that's a great way to crush demand and bring inflation down, and that makes central bankers happy for some strange reason. And then slowing wage growth at the end of last year should bring some relief. That feared wage price spiral will not unfold in the Eurozone. Well, it's unlikely because wages just have not been keeping up with inflation at all. But the ECB will definitely want to wait for first quarter wage growth data before deciding on rate cut. There's no reason here to change our call of a first cut in June. Indeed, it's likely to happen by the summer because we can see evidence that not only is the global economy slowing, but now it's starting to hit home at U.S. shores and impacting American households in a big way. And we can look at the relationship with unit labor costs here, then back to the U.S. data now against the consumer price index in red. And sure enough, as employers spend less money on employees, well, that means inflation comes down. The easy way to do that is to get rid of employees. And that is, again, the driver of productivity here that the Fed and these other central elites just can't see. We looked at ECB President Christine Lagarde last week, singled out salaries as, quote, an increasingly important driver of inflation dynamics in the coming quarters. Well, no surprise, if you don't want people to keep ahead of inflation, well, make sure they can't. And while cautioning against hasty decisions on easing policy without assurance that price gains are headed back to 2% target, and that means we know central bankers are going to keep these money curves inverted for longer than necessary, send us into the next recession. But even in a recession, there are companies that are going to shine, and we believe Dyadic International, our sponsor for today's show, is going to be one of those. You can find them on the NASDAQ under the symbol DYAI. All the information in the pinned comment and description. Let's take a look at what this company's doing because they've got big things coming over the next 12 to 24 months. And it's going to be a big catalyst, we think, to send their stock price much higher. And here you can note they're the next generation proteins for world health. This is just one aspect that they're focused on as we look at their technology, because over the last 2 decades, their C1 platform has been used to produce commercial quantities of industrial enzymes and other proteins. This proprietary and patent technology is a novel genetically engineered fungus that is highly productive and scalable in the areas of human and animal pharmaceuticals and alternative proteins in nutritional health. This is going to be big business for our sponsor and generate lots of revenue. Of course, you know, when revenue starts to tick higher, that means stock price goes with it. And that's why we see these two analysts with H.C. Wainwright and Zacks Smallcap have put a strong buy with a $6 price target on the stock. This is a huge number considering it's trading right around $1.30 at the time of filming. Let's take a look at what's going on here, because these microbial platforms are the foundation of the core business business for Dyadic. And here you can see their revenue potential increases with their time to commercialization. They've got a bunch of human and animal health products coming out, along with alternative proteins in the area of antibodies and vaccines, diagnostics, you name it. They are working on it here in a big way, and they have lots of stuff in development, with many of these already sponsored by their partners. This is big news because you can see potential Dyadic revenue coming in approximately 12 to 24 months for many of these, as they're focused on human immunization and drug delivery. Again, almost about 80% of these they have partner funding with already. And of course, they're also focused on alternative protein products currently in development. These coming starting as soon as this year, in the next 12 months. This is going to be, again, all sources of revenue to Dyadic, and that sets up the case of why we believe their stock price is going to head a lot higher. Now, let's take a look at the longer term picture here, because what you see in their stock is when it gets down to the current level. As I started the show out, we said that there's a setup here for a 46% move. That's because every time it's gotten down to this level, the stock just takes off as the sellers are worked out. So we're going to look back here over about the last year and a half, and I want to note that when stock gets down to the supply zone, and what happens in it just takes off like a rocket each and every time. Here you see 1, 2, 3, and now we're down here for the 4th time, setting up a big move. You have a short-term double bottom. This is huge, bounced off of its 50-day moving average, just short of that, and that's setting up the first move into this supply zone all the way up to that volume profile line. And you can see when it gets down here, it tends to get right up near that volume profile line. There's your 46% catalyst for the upside potential for Dyadic. Again, on the NASDAQ, on the symbol DYAI, here we can zoom into that double bottom here on the 90-day chart. It's very clear buyers continue to come in and support the stock at this level, setting again the initial move up in the supply zone at around $1.60, then with the further move higher into the above volume profile line, which is about a 46% move. And you can see here the double bottom is indeed supported by buyers. As we look over the last 30 days, buyers coming in here, giving you the opportunity to jump in with them and see this stock roar to the upside. Again, on the NASDAQ, on the symbol DYAI. And as always, with any company we feature on the show, you're under no obligation to purchase their stock. Please do your own research before making any trades. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.